It's one small step for man, one giant leap for mankind.
Welcome to The New Next, a podcast that addresses current events and how they will impact the future.
Yeah, and on the time horizon that you mentioned, even 20 years ago, the time a company would take from inception to IPO, it's been getting longer and longer and longer. So this is not the reason these things are 7 to 10 years, and Matt said they're pushing into 15-year funds is people are staying private longer. There are positives and minuses to staying private, but it used to be that maybe you would start and spin up and you would go IPO or sell in 2 to 5 years, and that would be great for a 7-year fund. But companies are staying private 10 plus years, and so even if you have thousands of employees, they all have private stock and they can't sell it. So it's like it's for the business, maybe it's a great way to grow and kind of grow without the overhead of public reporting and all that kind of stuff. But it has drastically changed how people build portfolios and things like that. And in terms of the institutional investors, pension funds and things like that you mentioned, even right now where we have the market going down, the public market going down, a lot of those places are asking these funds that they don't reprice their company until a new round to actually go and mark to market, to reevaluate their portfolios. And from a fund perspective, you prefer not to do that. It makes it look like you're losing money, you're down when those companies are continuing to grow, and in the future will probably, who knows, maybe be successful. But from a portfolio construction perspective for the institutional investors, they're now massively overweight on these private things, even though, because the public equities reprice and they go down, and it's like, well, they can't put any more money into this area, even when from a market perspective, it's a great time, if you have capital to put it to work. The prices and the multiples have come down. Maybe we'll continue to be kind of in this recessive state for another year or two, but this is when things get built, right? This is when people really, everybody that is leaving Amazon and Twitter right now, what are you going to do? Are you going to go build something? Are you going to, it's a great opportunity to find great deals. And
definitely,
if we look at the 2008 and 2007, crash and recession, the quote unquote smart money actually stayed out for way too long. And so, but it requires people to kind of suck it up, reprice stuff, be realistic about, what's going on and make some smart decisions. So.
Yeah, I think, like, to your point, we used to have a lot of regional stock exchanges and like Northwest, stuff like that. So you'd see a lot of companies IPO at a $40, $50 million valuation because they needed the capital. And like, my brother Eric he's director at Silicon Valley Bank, and they basically, or they're publicly traded now, but they started their niche thing with this venture debt investing. So they would provide debt capital, oftentimes along with financing rounds for companies, where it'd typically be more equity. So debt capital, and also warrants, where you provide debt capital that pays you money, but that debt is convertible into common stock in the future too. So they've kind of filled this niche for that capital need from, kind of your mid-series level investing level towards IPO, that's allowed people to basically extend, work more on kind of like I guess, gestating their baby, so to speak, leaving it in the womb a little bit longer. I don't know what to say before it gets out there and really goes. Because from an investor sense, up until recently, you'd typically eventually go to market and then get a higher multiple. So you'd capture more of the upside while it was private, and then also get a bigger bump once you actually like went to markets. But I think SoftBank, with just how much money that they had in recent years, really fragmented a lot of the markets. And you have companies like Silicon Valley Bank and other venture companies that have had still been really prudent investors and not got fully caught up in the hype, that are doing really well. But there's a lot of people that got caught with their pants down, so to speak, So, but it's
If you would like to learn more about the New Next podcast, find us at thenewnextpodcast.com, where you can suggest a topic you would like for us to cover. If you enjoyed what you heard, share the podcast, tell a friend about it, or rate us with 5 stars.